All right, hello everyone, and welcome to this retirement planning webinar. We are happy that you have joined us. Looks like we're shy of some expected participants, so I'm going to pause for just a minute or so and let some additional people join before I get started. So I will be right back. Thank you. Okay, just a few more joins. So I'm sure we'll probably have a few more people coming in along the way, but we'll go ahead and get started since we're at 2 minutes after the hour. So thank you for joining us. We are happy to have you with us. I am Stephanie Schmidt, and I am with the Sacramento County Employees Retirement System. I am an analyst here with SCERS, and if you're attending today's presentation, then you're considering retirement over the next few years, or you might be ready to submit an application, now, soon. So congratulations. Joining me today will be representatives from Fidelity, Social Security, the Employee Benefits Office, and SCREA. And they will review other aspects of retirement planning because it's not, SCERS is just not one piece of that puzzle for you. There are a lot of things that go into planning for retirement. So before I begin, just a few housekeeping items. There are panelists that are available to answer your questions, and that will be through the Q&A feature. So please post any questions that you have as we are all presenting in that Q&A, but please do not post anything that's personally identifiable, such as the Social Security number or anything like that. We don't want that in the Q&A. And keep in mind that each agency that's presenting is a separate entity. We're not all a one-stop shop. We each have our own niche in this process that you'll use to plan for retirement. And finally, if there's any conflicting information through the presentation or the Q&A, keep in mind that statute or policy prevails in that circumstance. So what are we going to talk about during our time together? We're going to review the basics of your retirement benefit, discuss benefit options and other decisions, review the tools that you have for estimating a benefit, and touch on things to think about now and after retirement. Additionally, you'll hear from the Employee Benefits Office, Social Security, Fidelity, and SCREA, as I mentioned. And we're all here to help you as you plan for retirement. So first, we'll talk about the basics of your benefits. SCERS manages your defined benefit pension plan. The plan is funded from employee and employer contributions plus earnings on investments. Upon meeting eligibility for retirement, the plan provides you with a lifetime monthly benefit and potential survivor benefits. The benefit you receive is based on 3 factors. It's very simple: your age, service, and final compensation at retirement. Your monthly benefit amount equals your age factor multiplied by service credit and multiplied by final compensation. You're eligible for retirement after you vest with 5 years of service credit, and you can apply for service retirement once you meet the eligibility criteria. So members with membership prior to January 1st of 2013 can service retire on or after age 50 with 10 years of service. Safety members can retire at any age with 20 years of service. Miscellaneous members can retire at any age with 30 years of service. A member can also earn 5 years of service to vest and then defer an additional 5 years to meet service requirements. Members who are PEPRA with membership on or after January 1st, 2013 can service retire with 5 years of service and with the age requirement, safety members on or after age 50 and miscellaneous members on or after age 52. Any member over the age of 70 can retire with any years of service. So your age factor is one component of that benefit calculation and is determined by your plan and tier. Your plan and tier is based on your job classification and the entry date into SCERS membership. So each plan and tier has a minimum and a maximum age factor as illustrated on this slide. The maximum safety age factor for tiers 1, 2, and 3 is 3%, and safety tier 4 is 2.7%. The maximum miscellaneous age factor for tiers 1, 2, and 3 is 2.611%. Miscellaneous tier 4 is 2.432%, and miscellaneous tier 5 is 2.5%. It's important to note that that age factor increases at every quarter age between that minimum and maximum. So the higher your age at retirement, the greater the factor will be until you reach that maximum. There is a full listing of those age factors by plan and tier in our member handbook, and it's available on our website at SCERS.org if you'd like to see those. The second component of your benefit is the service credit. So your service credit is earned each pay period based on the hours that you work up to a maximum of 80 hours each pay period. 1 year of work is equal to 1 year of service credit. And then at retirement, you can convert any unused sick leave to service credit. So that converted sick leave does not count towards your vesting, but it does increase your retirement benefit. So any sick leave that you've accumulated at retirement can help increase that benefit that you receive. The third component of your benefit is final compensation. So your final compensation is based on your highest consecutive 12 or 36-month period of pension eligible earnings based on your plan and tier. For tier 1 plans, final compensation is the highest consecutive 12-month period. For all other plans, the final compensation is the highest consecutive 36-month period. Your pension eligible earnings are reported to SCERS from your employer, and specific pay elements can be found in the appendix of your member handbook located on our website, which is SCERS.org. Not all special pay elements are included. For example, overtime pay is not pension eligible compensation. And for members that are considered PEPRA members joining membership after January 1st, 2013, final compensation is base pay only, and special pay elements aren't part of that retirement applicable pay. So at retirement, you will choose a benefit option. And once that option is paid, your election's irrevocable. So it is very important that you understand the different options that are available to you. So the unmodified option provides the largest benefit payable to you. If you are married or registered for at least 1 year, your surviving spouse or partner is entitled to a 60% continuance at your death. Option 1 provides you with a slightly reduced amount each month, but lowers your account balance at a much slower rate. So at retirement, you will have, again, your account balance that is made up of the contributions that you made into the plan and those interest attached to that. So with that option 1, it lowers the account balance at a much slower rate by just applying the annuity only portion of the benefit. There is no continuance with this option. So at your death, the designated beneficiary would receive any remaining account balance in that situation. Option 2 provides a reduced lifetime allowance and offers a 100% continuance to a surviving spouse, partner, or other eligible beneficiary. The reduction can be significant based on the age of the beneficiary. And as an example, this option allows you to maintain a level income for a surviving spouse or partner at your death. So what you receive at your death, your surviving spouse or partner would receive that same benefit for their lifetime. Option 3 provides a reduced lifetime benefit and offers a 50% continuance to a surviving spouse, a partner, or other eligible beneficiary. And this option allows you to select a continuance for a spouse or a partner if you've been married less than 1 year. So you might choose this option if you were married close or within a year of retirement. And you can find more information with a little bit more detail on each of these options in the member handbook on our website at SCERS.org. As you plan for retirement, you might wish to purchase any missing time that you took for various reasons, such as medical leave of absence, other periods of employment, such as temporary employment, or service that you may have had prior to membership, such as with another eligible public agency or the military. If you previously terminated employment, you refunded, and then you later returned to covered employment, you can redeposit service and contributions. You're encouraged to request a service purchase well in advance of your planned retirement date because at certain peak times of the year, purchase calculations can take 6 months or potentially longer to receive. In addition, you may need to obtain information from an outside source like your employer or a doctor to support your request. You can access a purchase packet on our website at SCERS.org, or you can send an email request to our reception team at sacretire@saccounty.gov. Additionally, to keep in mind, the cost of purchasing service increases over time. The longer you wait, the higher the cost. Purchases are calculated as if the service and the contributions were made at the same time. So you're paying for your contributions, the employer contributions, and then any associated interest that would have applied retroactive to that period of time for that purchase. You must complete all purchase requests before you retire. If you have an outstanding purchase balance at the time of retirement, it must be paid off or the service will be prorated. The exception is a redeposit purchase. So if you terminated, refunded, then later returned to cover employment, and then you elected to redeposit, that service is all or nothing. So if you have an outstanding balance on a redeposit purchase at retirement, it has to be paid off in full, or all of the service, the contributions, and the interest will be refunded to you. And if you elected a redeposit to re-enter, meaning you were put into a better tier with that redeposit and you don't pay off that balance, you'll be moved to the most recent plan and tier and you'll receive a lesser retirement benefit. So it's very important that you pay off any redeposit purchase. Purchases can be paid for by lump sum payment. You can use personal check. You can complete a rollover from another qualified plan like the county's 457 plan. And you can also elect a payroll deduction. So you have some options for completing a purchase request. As you plan for retirement, I strongly encourage you to use the benefit calculator so you have an idea of your monthly benefit in retirement. It's the best tool to help you plan appropriately. The benefit calculator can be found on our homepage of the website, like this slide is illustrating. You can use the contact tool to request a password if you don't already have one. But using a password helps because it pre-populates the input fields that are important in the calculation, such as your plan, your tier, your service, your age, and even your most recent final compensation. Keep in mind that you can use the calculator as much as you like by entering various retirement dates to help you plan, because as I mentioned previously, there's that age factor. So if you haven't hit the maximum age, you can populate, every quarter age for the next 2 years to see if there's any particular date that gets you that benefit that you're looking for. You can also use the calculator without data. There is that option if you don't have a password, but be aware that if you use that option, any of your input drives the result. So if you select an incorrect plan and tier, if you somehow confuse service credits with service years, all of that will result in a benefit that is not correct. So I do encourage you to request a password if you don't have one. Our member handbook also has a manual fill-in version of the calculation in the appendix. So if you prefer that option, you can use that, find your age factor in the handbook, and calculate it that way as well. So this slide illustrates an example of a calculation for a member in miscellaneous tier 3 that is 55 and a half with 15 years of service and has $6,000 in 36-month final compensation. So to determine the benefit, as I said previously, it's a simple formula. You multiply the age factor. In this situation, the miscellaneous tier 3 55 and a half factor is 2%. By the 15 years of service, and then you multiply that by the $6,000 of 36-month final compensation, and that results in a gross unmodified benefit of $1,800 a month. So from that example, this is the type of result you would see from the benefit calculator, which lists each of the available options. Again, the survivor continuance options will be listed based on the input in the calculator. So if you have a spouse partner, it'll ask you for that date of birth, and that will generate the available continuance options. The unmodified benefit is the largest benefit payable to you. And then that also provides a 60% continuance to a surviving spouse or partner. Option 1 is a slight reduction to you with no continuance. But again, that option draws down that account balance that you retire with at a much lower rate, just using the annuity portion of the benefit only. So that might leave a potential lump sum payment for a beneficiary at your death. Option 2 is a reduction in your benefit to provide 100% continuance to a surviving spouse, partner, another eligible beneficiary. And again, that option seeks to kind of leave income level for that surviving beneficiary. Option 3 is a reduced benefit with 50% continuance to a surviving spouse, partner, or eligible beneficiary. But remember that you have to be married at least a year at retirement for that continuance in an unmodified form of payment. So this option 3, if you've been married less than a year, would be a way for you to leave a continuance without taking a hit as option 2 would leave you with. So we're often asked, what do I need to know before retirement? There's a lot of things that you need to know, but using the benefit calculator to estimate your benefit when determining your retirement readiness is the best thing that you can do to plan appropriately for retirement. Additionally, did you work for another public employer in California? Reciprocity might apply if you had no overlapping service and no more than a 6-month gap in employment between reciprocal systems. That reciprocity establishes a link between the systems, and then the service counts toward vesting. We also share salary information so that you get the greatest final compensation between the systems. So for example, if you had service with PERS previously and came to SCERS and our final compensation is the highest, we will share that information with PERS and they'll use our salary to calculate your benefit with them. So if you think you may have reciprocity, but you haven't established it yet, please contact us separately so that we can get that process moving. You have to retire on the same date with all reciprocal agencies. It must be concurrent. If you don't share the same retirement date, then reciprocity is broken. Also, did you divorce or were you deregistered during your employment with the county? Was your status when you entered county service divorced? A spouse or partner has a vested interest in your retirement account as community property. So SCERS has to have any judgment, marital settlement agreement, joinder for each divorced spouse or partner. And our divorce policy provides members with up to 6 months and a potential 2-month extension to resolve any outstanding divorce issues that we might discover during the retirement process. You can retain the requested retirement date as long as those issues are resolved within that 6 to 8 month period. If the issues aren't resolved, then your retirement will be canceled. You'll have to reapply with a new retirement date once the divorce has been approved by the court. If for any reason you're unsure of what your status may have been at your entry, or if you know that you divorced, but you're just not sure if you provided SCERS with that documentation, please contact us. You can either email us at sacretire@saccounty.gov, or you can call us and a specialist can review your account to let you know that status. There are certain documents that are required to process your retirement application. We have to verify the data inputs, such as your date of birth, the birth date of your beneficiary that would be receiving a continuance. We would need proof of marriage or registration if that's applicable to you. So be sure that you locate your birth certificate, a passport, the birth certificate or passport of your spouse, your partner, or any other eligible beneficiary in your marriage or registration certificate, if that applies, in the event they've been misplaced or lost. If you don't have those items, it might take some time to request them from the issuing authority, and you don't have to wait until retirement to provide that to us. You can provide them at any time, and we'll attach that to your account so that at the time you're ready, then that information will already be on file. But if you fail to provide it timely, then it will definitely delay your retirement. We can't process your retirement until we have that information to validate. A complete list of the required documents is available in the service retirement package on our website at SCERS.org if you'd like to review that now. Choosing a date. We do get questions frequently about, what's the best date. Choosing a retirement date is a personal decision, and only you know when you're ready for retirement. I can tell you that your retirement date can be any day of the week, but you want to be sure that you choose a date, the day after your last work day, to avoid a lapse in payment. So if your retirement date was today, then your last work day would have been yesterday. So you don't want to have a gap. Sometimes we'll see people who will work the last day on a Friday, and then they submit maybe a Monday as their retirement date because they think they have to wait, in the calendar. You don't. You want it to be the next day after, so you have no lapse in payment. The retirement date must be a date after your last day worked, though. So if you work on your retirement date, SCERS will change the date to the next day, and we'll notify you that we've done that. Once you're ready to retire, you must submit an original signed retirement application to SCERS, and we can accept that application up to 60 calendar days in advance, but no more than 60 days, not even a day early, according to our county employees retirement law. Any application received in advance of the 60 days will be rejected and returned to the applicant. Likewise, you can't backdate an application. Any application received after the retirement date has passed will have the retirement date changed to the date we receive it. Any applications that come in with no retirement date will be given a date of the date we receive it. We strongly recommend that you submit your application within that 60-day notice timeframe and give us as much time as possible in order to process that and review and research your account. Once an application is received, our staff will notify your department and the Employee Benefits Office. Your account will be reviewed. You'll receive a retirement package. That package is generated with the information that we have at the time that it's calculated. And then after reviewing the package, you'll select one of those options and return that election to SCERS. And once SCERS receives your final pay information from your employer, then any additional transactions that posted after your initial package was generated is recalculated, and then we determine your final benefit from that. Our staff will notify you of any anticipated payment date, and then they'll send you written confirmation of the election that you made, and then that final monthly benefit amount. And then at certain retirement dates, just keep in mind, for us, that's generally January to March. Your first payment might not arrive for 60 to upwards of 90 days. So it's important to plan financially for that gap in funds coming into you. Your first payment, though, will represent amounts that are retroactive to your retirement date. So you will be made whole. It's just that during certain peak times of the year, we receive the largest chunk of applications. And so it takes us some time to get through all of those. For planning purposes, it's helpful to note that in retirement, you're paid on the last business day of the month for that current month. So for example, June 30th, the payment represents June 1st through June 30th. If you elect deductions, they will be taken from your retirement check. So for federal and state taxes, plus any benefits that you elect. It's also important to inform SCERS of any address changes, because we send you quarterly newsletters, we send board election materials, you get your 1099 every year that you'll need for tax filing. You can update your address anytime, but note that we don't automatically update state tax withholding if you move outside of California. We also can't deduct taxes for states other than California. You can make changes to your tax withholding, your banking information, your beneficiary anytime. Keep in mind that your beneficiary might receive a $4,000 burial allowance. So you want to be sure that you keep those beneficiaries updated if you have changes. As a retiree, you receive a cost of living adjustment each year in April. And that depends on your plan and your tier based on the Bay Area Consumer Price Index, with the limited exception of miscellaneous tier 2, which doesn't receive a COLA. The cost of living adjustment is generally up to 2%, except tier 1, which can be up to 4%. And the annual COLA is tracked on our website, and it's communicated in our newsletter. In order to receive the COLA for the current year, your retirement date must be on or before March 31st of the same year. After retirement, you might consider going back to work. I know that seems like a shock, but we do see it either as a retired annuitant or as a permanent employee. If you're employed in the private sector or an outside Sacramento County or outside of another SCERS participating employer, your retirement benefits not impacted, so no issue there. If you return as a retired annuitant, working for another county department or another one of our participating employers, you have to wait 180 days before you return to that retired annuitant assignment. There is a limited exception to that waiting period for safety positions. Additionally, if you're limited to no more than 960 hours per year. So if you exceed that hour limit, we'll have to suspend your pension and you'll be enrolled as a contributing member. So keep that in mind if you're entertaining a retired annuitant position. After retirement, you might decide to return to permanent full-time employment. There are lots of reasons for that. You know, your circumstances may have changed. You might actually miss working. You might not want to be home with whoever you're home with or whatever your reason is. We do see people that come back to permanent employment. So in that event, you'll just arrange the employment with that employer department and then provide SCERS with the completed benefit suspension request and proof of that return to work date. And so what we'll do from there is suspend your pension on the day before that return to work date with the employer. Returning to permanent employment can add additional service credit. It can potentially increase your final compensation. If you were not at the maximum age, that age factor might increase as well. And then when you are at the point that you're ready to re-retire, you would submit another retirement application, go through that same process for that period that you return to work. So we would calculate a separate benefit for that duration of the return to work. Then your suspended benefit will be reinstated We'll apply any COLAs that may have applied during that period of suspension. And then we'll combine it with that new benefit to get your new monthly benefit amount effective with that new retirement date that you elected. So this concludes the SCERS portion of this presentation. Next up, I believe we have Mike Gomes with Fidelity. So he'll go through some information with Fidelity. When he's finished, then we'll pick back up with our other presenters. And just as a reminder, continue to post those questions in the Q&A, and they'll be answered for the duration of the webinar. So I'm going to mute myself and stop my video and stop sharing, and I'll let Mike take over.
Thank you, Stephanie. Just getting set up here, so bear with me one quick sec. There we go. All right, hopefully everybody sees my screen here. So as Stephanie mentioned, my name is Mike Gomes. I am the workplace financial consultant for the County of Sacramento's Deferred Compensation Plan. Just want to share a brief background about my role and how I support the county, and then I want to dive into some of the material that I wanted to share with you all. So I started with Fidelity in 2014. I'm locally based. I am in Rockland, and my offices, or our Fidelity local offices, are in Roseville, Sacramento, and Folsom. Prior to taking on the county dedicated workplace financial consultant role, I was a planning consultant in our local offices here in both Roseville and Sacramento. And my primary function was to create, review, and implement retirement plans for our retail segment. So those would be people who wanted to work with us that may not have a workplace plan, or they may not be currently employed, so they're retirees that are working with the local retail offices. So as a planning consultant, one of the benefits I got to encounter in my role was being able to help people transition in retirement. And that's really what I specialize here with the county, is helping the retiree segment or pre-retiree segment really get all your ducks in a row so that you can have a successful transition into retirement. And so one of the benefits of working together with Fidelity is that we do get to go through some of our retirement planning tools and resources we have available. And I would encourage you, if you haven't ever had a chance to meet with me, and I'll share my information with you here momentarily on how to schedule some time to meet with me. But if you have never gone through any of our retirement planning analysis or software, please feel free to schedule some time with me. I think that would be a great opportunity as you start to prepare for retirement and making sure that you have your targeted numbers in place. Other things that I can assist with is if you are, planning on looking at ways to maximize your contributions prior to retirement, looking at your investment options, tracking your progress in your plan, please feel free to schedule some time to meet with me. I'm happy to help with those types of conversations as well. And then lastly, one of the great benefits of Fidelity is we do educational workshops on a monthly basis. And so those are always published on our website, and the county sends that information out as well. So our Ask Fidelity sessions are designed to give you some information about things that we are helping you prepare for retirement. It could be ways to transition to retirement. It could be looking at Medicare, Social Security. It could be looking at required minimum distributions, how the market is impacting retirement, all those types of things that we want to help prepare as you start to think about what the next maybe 2, 3, 4 years look like, or maybe the next 2 or 3, 4 days look like if you're that close to retirement. So please feel free to schedule some time to meet with me. And again, the last slide that I'll put up will have my information on there. I'm going to switch over to our presentation now, and give me 1 second here. And I've got my partners here. Amy with our benefits office will be working on the Q&A. So if you do have some questions, please feel free to put those into the Q&A chat. She'll be assisting me with the Q&A functions here. So there we go. All right, so hopefully my screen worked. I am working out of a web browser, so it's a little challenging for me to see what's happening on your end. So hopefully my screen is up for you all. We put together some slides to help you consider some options for transitioning as part of your retirement with your deferred comp plan. And with the 457B, there's some things we want to consider, and here's some helpful things that we always try to encourage people to prepare for is what happens with your 457B and or your 401A accounts once you leave the county, once you terminate or retire. What are some of the distribution options that are available to you? Obviously, we want to make sure the beneficiaries are updated. We'll talk about that here momentarily. And then also looking at the contacts and resources that are available to you to get help with your 457B or your 401A and what's offered through Fidelity. So some important things to know as you start to think about transitioning retirement. When you retire, you will not have the option to contribute any longer to your 457B plan. That would stop your contributions, and your final pay, if you elect to have some of that deferral go into your 457B plan, that would be the last of your ability to contribute to the plan. Some of the things that you can work directly with Fidelity on would be to modify your investment choices. As I mentioned earlier, we do full retirement and investment strategy review. If you have a change of address, if you want to change your beneficiaries, if you want to take distributions or potentially roll over your assets, those are some of the things that you might want to work with Fidelity on. If you haven't ever gone to our Net Benefits website, I would encourage you to go and log into netbenefits.com/SacCounty. That will give you access to your 457B plan, and all the other resources are available on our website for you. Or you can also call our customer service group if you have immediate questions and you don't want to schedule some time to meet with me and you just have some questions that you want to ask. Our service line, our retirement benefits team, that phone number is on the screen there. It's 800-343-0860. So here's some additional things you may need to consider about your 457B. One of the benefits of a 457B as it compares to potentially your 401A, or if you had a 401K outside, or maybe an IRA that you have, the 457B does not have an early withdrawal penalty. So if you're pulling money out of your plan, if you're retiring before 59.5 or separating from the county before 59.5, there would be no early withdrawal penalty for you to take distributions. Now, any pre-tax contributions would be taxed to you, obviously, but you would not have any early withdrawal penalties on any of the pre-tax portions of your distributions. That differs from your 401A because your 401A does have early withdrawal penalties if taken before 59.5. So if you do have a 401A and that is available to you, just keep in mind there's a difference between taking distributions from your 457B and then taking distributions from your 401A. Upon termination or retirement, there's some distribution options to consider. You can take a lump sum of your entire balance if that was something that you want. In one of our next slides, we'll talk about the lump sum option. You could take a portion of your balance and move it out of the plan and into, or take a distribution and move it into your checking account or savings account. You could take periodic distributions, or what we call systematic withdrawals, and those can be set up monthly, quarterly, or annually. You could also roll out your plan if you, as Stephanie mentioned earlier, sometimes you retire from the county and you might go on to do other things. If they do offer an employer plan, you could move your money into one of your new employer plans, or you could also move it into an IRA. And again, I'll talk about that here in a second. And then lastly, we do encourage anyone who's thinking about taking distributions to speak to a tax professional about what the impact of that might be on not only your Social Security payments, but also on your Medicare Part B costs. So there are some potential impacts that you might have to consider. And again, we're not tax professionals, but we do encourage you to speak with somebody about that because we don't want any surprises to take place if you were taking distributions from your deferred comp plans. All right, so moving on to the next slide here. There we go. We talked about some of the retirement distribution options, and we put those up on the screen for you here. So you could stay in your 457B plan. The county will not force you out of the plan. You can keep your assets with the county plan as long as you wish. As I mentioned, if you were to leave the county and go work for another employer, and if they do offer a workplace plan and they allow you to move assets in, you could definitely move your assets into your new workplace plan. You can also move it to an IRA. So if you have an IRA outside of your county plan and you want to consolidate into an IRA, you could do that. And again, you could also take a withdrawal of your assets either in the full amount or take partial distributions from the county plan. And we'll dive into each of these here on the next slide. So some of the potential benefits and some things to consider of each of these distribution options is if you are staying in your employer plan, obviously you continue tax deferred growth from your plan, the ability to stay invested in plan specific investments or have your money managed with the Fidelity management services that we offer, and then unlimited credit protection in and outside of bankruptcy. So your workplace plans have different creditor protections versus IRAs. And that is definitely one thing to consider about your distribution choices or rollover options is what that would look like. And we can talk about that individually in one-on-one sessions about what those credit protection limits are versus, or I should say, an IRA versus your workplace plan. Some things to consider, options, if you were staying in the workplace plan, you may have limited options for investments, for withdrawals, and your beneficiaries. Those are just things to consider. And this is a little bit more generalized, not necessarily specific to the county plan, but if you have, if you're thinking about keeping money inside of workplace plans, these are just general things to consider. If you have a minimum balance, your employer may make the decision to distribute your assets. We call that a de minimis rule. So if you're under a certain balance, your employer may just force you out of the plan. And it may be easy to neglect or overlook investments when trying to manage multiple accounts. So if you have multiple workplace accounts, that's definitely one thing to consider, is consolidating into one place to make it easy for you as you start to prepare or transition into retirement. Not going to go through all of these, but roll over to a new workplace plan. Again, some things to consider is if you are going to leave the county and move into a new employer, you can move your assets into your new employer plan if that employer plan allows you to do that. So continued tax deferred growth is a benefit, combining plan accounts into one for easier tracking and management. Again, that's just making sure everything's consolidated. If you're still working after you turn 73, that is one thing to consider, is moving your assets into a workplace plan, because if your assets are in a workplace plan and you've reached your minimum required distribution age, you do not have to take your minimum required distribution at that point. Potential availability of plan loans. So again, if you're thinking about taking a loan out of your plan, once you are no longer active in an employer plan, generally you're not permitted to take a loan. So if you do have a new employer plan and you are considering your loan options, that might be something to consider. Again, unlimited credit protection in and outside of bankruptcy. Those are things that would be potential benefits of moving your money into a new employer plan if you were to work beyond the county, the scope of the county's employment. Some things to consider again, any outstanding loans taken from your existing workplace savings plan. If you default on that loan, you could be subject to a 10% early withdrawal penalty if you are under the age of 59 and a half. You might also be subject to your new employer's plan rules, and there may be some additional fees and expenses that vary by plan. So those are just things to consider when thinking about rolling into a new employer plan. And again, if we're thinking about moving our assets into an IRA, on the screen here, you'll see some of the benefits. This is a common theme: continued growth for your savings, consolidation of multiple accounts for easy management. That's another common theme. A lot of people I work with, consolidating assets in retirement is a definite conversation we like to have, because it does make things easier, so you don't have multiple accounts lingering out there and then having to consider multiple distribution options from each different account. That can be a little taxing for trying to generate income or trying to figure out sources to generate income. Penalty-free withdrawals for qualified first-time home purchases. That might be something to consider if you're under the age of 59 and a half and retiring. An IRA may allow you to do that. So just things to consider about distribution options. Things to consider: you can't take loans from an IRA. You would lose access to some of the low-cost or custom investments that might be available in your workplace plan. You could potentially lose, you could lose the potential to defer your minimum required distributions. Again, in an IRA, no matter the assets in your IRA, that would all be considered as part of your minimum required distribution when you turn 73. Creditor protection of qualified plan assets is unlimited under federal law, but there are certain protections that vary by state. as far as IRAs are concerned. So that might be something to consider as well. And then you obviously want to explore any fees and expenses that you might be assessed inside of an IRA. Last option, you could withdraw all your money from the plan. Potential benefits, you have immediate access to your savings. So you could withdraw your money, you have access to that balance of whatever you have. You can take partial distributions that have immediate access, and obviously then continue the growth of whatever is left in the plan or in your IRA. Stay invested in your plan's options, and you might not have any restrictions on the number of or frequency of partial distributions. So those are all things to consider, because oftentimes if you do have assets that you roll into another employer plan from your current employer, so if you left the county and you rolled it into another employer plan, you may have limited distributions to consider. If you're retired from the county and you don't plan on working anywhere else, you can set up your distribution options any way you want. That's definitely one of the benefits of having the 457B, is there are no limitations or restrictions on the number or the frequency of taking distributions. Things to consider: full withdrawals. Those would be taxed to you at a 20% federal income tax, and then obviously possible state income tax withholdings depending on what state you live in. A 10% early withdrawal penalty if you're under the age of 59 and a half for your 401A. As I mentioned earlier, that does not apply to your 457B. Taking a full withdrawal would mean you'd have less money for retirement. Definitely something to consider. And again, partial withdrawal is kind of the same information there as far as what partial withdrawals, things to consider for partial withdrawals. We don't want you to run out of money. So that's an important thing, is using a sustainable withdrawal rate. So when we talk about a sustainable withdrawal rate, Fidelity's rule of thumb is we try to encourage people to consider, if you are taking distributions, to keep it within some parameters. We find that taking about 4 to 5% in the first year of retirement can help stretch your money out. Those are the things we have to consider, is what our withdrawal rates are. Because if we're taking significant withdrawals out of our 457B or any retirement account for that matter, and let's just say the market is not cooperating with us, could potentially decrease your savings for longer periods of time. We would consider that double dipping. You're taking money out and the market's going down. Now you have variables that are out of your control, and you may see your balance decreasing at a more significant rate. So we do want to make sure that we have the right withdrawal or distribution strategy in place, things that we can definitely work on together. I mentioned earlier, you will be required to take required to take minimum distributions at the age of 73. If you are thinking, well, 73, that doesn't sound familiar, what happened there? That age limit has gone up, or that age requirement has gone up over the last several years. We are now at age 73. So if you have not reached your minimum required distribution age yet, you won't have to worry about that until you turn 73. Remember, the deadline to take minimum required distributions is December 31st, except for the first year in which you turn 73. So if you've turned 73 and you have not taken your minimum required distribution in the year that you turn 73, you have until April 1st of the following year. However, keep in mind that would mean you'd have to take 2 for that next year. So you'd have to worry about the tax liabilities and distributions on having 2 required minimum distributions for that year. The amount depends on your age. It will go up over time. They look at your balance of your assets as of December 31st of the previous year. That would determine the withdrawal balance. And then your age, there's a table that you can find on fidelity.com that will help you calculate what your minimum required distributions may look like, but it depends on your age. And one thing to keep in mind is that if you do not take your minimum required distribution accordingly, you would be assessed a penalty by the IRS. That could be 25% of the amount not taken. So we really want to encourage you to pay attention to those minimum required distribution rules, and also make sure that if you don't want to manage that process on your own, Fidelity can automate that for you so that you can have those distributions sent to you automatically. It eliminates you having to think about when I should be taking them, how I should be taking them. And obviously the main thing is we want to help you avoid the potential of forgetting about that or not taking it and having a penalty assessed to you. Okay, so again, we talked about some of these things. One thing I want to highlight on this slide here is that you do not have to take minimum required distributions from Roth assets. So pre-tax assets are going to be part of your minimum required distribution. Roth assets are not part of your minimum required distribution. One other quick bullet point on here that I want to talk about is the calculation. I mentioned online how it's calculated based off your balance and life expectancy. We do, as I said on the previous slide, Fidelity has a really great resource on fidelity.com. You can just type in required minimum distribution on our website, and that will pull you directly to the calculator. It allows you to plug in the information that you would need to have that calculation done. It helps you estimate out what your potential required minimum distributions would look like over time. So really some great resources there that we can help you out with. All right, so things to also know. You can start, stop, or adjust your distribution amounts at any time from your deferred comp. So if you started your distributions and you're thinking, hey, I don't need that money anymore, or I want to reduce that, you can definitely do that. You can specify a particular fund from which to make distributions. So if you hold multiple investments in your plan, you can specify how you want those distributions to come out. We do make it available for direct deposit, so you can have that directly deposited into your account. And again, just a reminder, you would be assessed taxes on any of the pre-tax distributions you're taking. As the plan dictates, you do have to withhold a minimum of 20% federal, and if you are in the state of California, it would be 2% state taxes. Fidelity will always send you a 1099 each January for any types of distributions that you took. And we do publish that information online for you as well to be able to find. Okay, so distributions from Roth. So Roth distributions are tax-free if your account was established 5 or more years prior to taking distributions and you're over the age of 59 and a half. So those are definitely some things to consider if you have Roth assets, is when you can start taking those distributions as tax-free distributions. Those are the rules. 5 or more years you have to have a Roth established for, and you have to be over the age of 59 and a half. If you have questions about your Roth distributions, please make sure that you reach out to a financial advisor. You can reach out to me, of course, but talk about your Roth distributions, because what we don't want is you to be under the impression that you can take Roth distributions if you don't meet the certain requirements, and then the benefits of the Roth assets you have would be negated because you may not met one of the rules for Roth distributions. Again, you will always receive a 1099 for any distributions you take. And then all of the same distributions for the previous slide are available to you, which are having it direct deposited into an account. You can start, stop at any time. You can pick from individual funds to have distributions coming from as well. All right, so as we will always remind everybody, please make sure you always keep your beneficiaries up to date. So beneficiaries should always be updated through Fidelity. Remember that SCERS beneficiaries are different as far as the systems go for Fidelity beneficiaries. So if you updated your SCERS beneficiaries, please make sure that at the same time you're thinking about updating your Fidelity beneficiaries on your deferred comp plans. Those systems do not communicate, and I get that a lot. That, I work with people that say, "Oh, I updated my beneficiaries on the SCERS side. I didn't know how to do it on the Fidelity side." So please make sure that you are always updating your beneficiaries. You can update your beneficiaries online at netbenefits.com. All you need to do is click on the Accounts and Benefits tab and click on Update Beneficiaries, follow the instructions. We only require first and last name and date of birth. So we don't require social security numbers, nor do we require addresses. So we try to make it as simple as possible for you. Okay, ways to contact not only Fidelity, but the county, and things to be able to handle through each of these two entities. So with Fidelity, you're going to want to contact us to set up distributions from your plan. If you have any type of investment decisions you're making to exchange funds, you can do that through Fidelity. If you're looking at Roth conversions from pre-tax to your Roth bucket, you can do that through Fidelity. Change beneficiaries, change your name and address. Those are some of the service items through Fidelity's retirement benefits team that you can take care of. We've published the phone number for you here, 800-343-0860, or you can do that through netbenefits.com. There's some other things outside of Fidelity scope that you would have to handle through the county. There's a 3-year limited catch-up program that the county offers. If you don't know what that is, please feel free to contact me to get an overview of that. But that is a county-sponsored program, so that needs to be done through the county as far as setting that up. But I can help you with that. The county can also help you with that as well, county benefits team. But if you have questions, that's definitely something within the scope that we can talk about. Accrual calculations, valuations, your final paycheck contributions, any general 457B questions, the retirement annuitant enrollment program, those would be all things that you'd want to contact the Employee Benefits Office. And we did publish their phone number and email on the screen here. Okay, lastly, how to be able to schedule some time to meet with me. So my direct phone number is on the screen, 916-721-2698. You can also schedule some time through fidelity.com/schedule, or you can call our scheduling center at 800-642-7131, and one of my colleagues can definitely schedule some time to be able to work with me. I do in-person appointments. I'm out in the field a lot these days, hitting up different departments. So please look out for emails from your department managers that would indicate what times I'll be there. I also am doing appointments, and today actually I am downtown at the 700 A Street building. We have an office set up here that I work out of, so typically once a week I'm in this building. So if you go to fidelity.com and you want to schedule an in-person appointment on the appointment type, you can just click on the drop down. It'll give you when I'm on site at the 700 A Street building, and always happy to do phone and virtual appointments as well. Okay, lastly, a couple other quick things. netbenefits.com/Sac County, quick access to your deferred comp plan, account information, balances, investments, transaction requests. We have a lot of educational resources in our learning tab. We have Fidelity Viewpoints, which are articles we publish about potential, things to consider for retirement, market updates, things like that. We have videos that you can participate in, webinars that you can, national webinars that we offer. You can look at your financial goals. You can look at your planning summary. All of those things are available through Net Benefits. I do encourage you that if you have never run through a retirement plan with a financial advisor, it's never too soon to do that. So please work with me on setting that up. It's a complimentary service to you. Working with me is a complimentary service to you through the county and Fidelity. So I would encourage you, schedule some time. Even if you just have really general questions, it's always good to talk about it, to educate yourself, to help transition into the retirement phase. Okay, that's going to do it for me. I'm going to go ahead and stop sharing my screen and turn it back over to Stephanie. Thank you so much.
Okay, thank you, Mike. Appreciate it. So next up, we have Michael with the Social Security Administration, who's going to walk you through all the benefits of Social Security. So take it away, Mike.
Good morning, everyone. Thank you. And as mentioned, my name is Michael Teixeira. I'm the Public Affairs Specialist here with the Social Security Administration, based out of the Northern California area, specifically Sacramento area. So I wanted to start off by congratulating you all on thinking about your future retirement. I know it can be an exciting time and a bit confusing all at once. So today, the purpose of today's presentation, we'll briefly cover various topics. But before we begin, I just wanted to mention that Social Security with you through life's journeys. Today's presentation is current as of June of 2023. And the material in this presentation has been prepared by the Social Security Administration's Public Affairs Office and is intended for educational purposes only. Participation in this presentation does not necessarily constitute an endorsement by SSA or its employees of the organizations and informations and products not covered by SSA, aka the other presentations here. So today we'll go over how retirement benefits work, planning for retirement, deciding when to start retirement benefits, what else affects your retirement benefits, what about Medicare, and then lastly, how to apply. I will just briefly mention also, many of the questions that arise throughout the presentation are typically answered. So if you'd like to hold off towards the end, if not, that's fine, and we'll try to get to as many as we can before today's event is over. So let's go ahead and begin here with the how to get access from Social Security. Social Security is here to help you. We want you to know how to get the service you need and be prepared so we can help you as quickly as possible. So there's three main ways to get service from Social Security. The first is our website, which I'll review in the next few slides. The next is if you cannot use our website, you can always call our national 800 number or your local Social Security office for help. Just to further explain that piece there, those are two separate numbers. So our national 800 number, the 1-800-772-1213, is a number that is handled by multiple teleservice agencies or teleservice centers throughout the nation. Then there's also a link to your local Social Security office, specifically, in your area, that'll be able to assist you further if you have specific questions. If you're not able to access us via telephone, you can always visit our local field offices. In-office appointments are no longer required, but they are strongly recommended. So as I mentioned, the Social Security website is a great resource. It's an excellent tool. All the information covered today, or even not covered today, if you have additional questions or just need clarification on topics, can be found on our website at www.ssa.gov. If you want to research a specific topic, you can simply put it in the search bar there at the top right-hand corner. We've streamlined the website to better find the given topics that you need. And so let me pull up my laser pointer here. So before, the website was quite busy. There was a lot of images and whatnot on our website. So now we've kind of broken it down based on topics, prepare, apply, and after you apply it. So and they'll walk you through what sort of benefits you could be potentially eligible for. Once it's time to apply, you can also apply for benefits and sign up for Medicare. You can also check the application or appeal status and appeal a decision you've made if you do not agree with that specific decision. In addition to our website, My Social Security is a great and secure suite of services. It's designed to put you in control of all your Social Security needs. So you'll be able to see future estimates for family members, spouses, things like that. All the information is covered there in your My Social Security account. If you do not receive benefits, you can compare your retirement benefit estimates. You can request a replacement Social Security card. You can check the status of your application or appeal. You can get a benefit verification letter as proof that you are not getting benefits. And most importantly, you can get your Social Security statement to review. This gives you estimates of your future retirement, disability, and survivor benefits. You're able to view your earnings and make sure that they match on that Social Security statement. And I'll go through and kind of walk you through what the Social Security statement looks like now. Once on benefits or receiving Medicare, you can opt out of mailed notices for those available online. Again, request a replacement Social Security card if you meet certain requirements. You can report wages. You can get a benefit verification. You can check your payment and benefit information. You can change your address and phone number and direct deposit. As you see here, there's a variety of services that we offer now online that you in the past would probably have had to call us or visit a local field office, but you can now conduct all these services listed here via your My Social Security account. So the Social Security statement, as I mentioned earlier, this is a great resource. If you don't have access to your My Social Security account, you can always call us and we can mail this out to you. We in the past did mail these out periodically. We would mail them on milestone years, as we called them. We've since gone away from mailing those out to anyone under the age of 60. If you're over the age of 60, do not have a My Social Security account, you will receive one of these in the mail. But again, the best way to receive your Social Security statement is via your My Social Security account. And that's because there's a variety of links that are active here as it breaks down the multiple topics. And what I really enjoy about your Social Security statement is not only do they give you your retirement estimate, but as I mentioned earlier, it gives you your disability benefit estimate. If you were to you were to file for disability, it would break it down for you how much you would be receiving in disability benefits. It would let you know if you had minor children, spouses. It also explains those topics too. And it allows you to click on these links. It goes over and reviews Medicare benefits, how to qualify for Medicare, which we'll review here in a little bit as well. But most importantly, prior to retirement, it's important to check your earnings statement, because there's nothing more frustrating than having to go back and forth between IRS and Social Security when you're looking to actually receive your benefit, right? And so it's important if there is any discrepancies to handle that prior to your retirement age. And the best way to do that, again, is to ensure that the earnings that were reported from IRS are accurate as of what you believe they should be. And as I mentioned, the retirement benefits calculator is a great resource to get that future benefit estimate. It allows you to view how much your benefit would be at any specific date or age. Again, it breaks it down: early retirement at age 62, how much your benefit would be, your full retirement age at age 70, if you choose to delay that benefit. You can also put in future earnings. And it'll break it down for you. So I know a lot of folks typically have a specific age in mind. You can also do that. You can put that age here, month and year. You can put the specific date. If, for example, you and your spouse are looking to retire at the same time, or you're just looking to retire on a specific date from your employer, and you want it to coincide with your Social Security statements, you can also do that via the retirement benefits calculator. In addition to that calculator, they also provide charts if you're like a visual person like myself, and it shows how the benefit accrues and increases over time if you choose to delay your retirement benefit. And we'll go over some of those basics here in the next few slides. So let's now review how to qualify for Social Security benefits. So your 9-digit number helps SSA accurately record your covered wages or self-employment. As you work and pay FICA taxes, you earn credit for Social Security benefits. So to qualify, again, this is to simply qualify for benefits, you'll need to work for at least 10 years or earn 40 covered credits of coverage. Obviously, the more you earn, the more you'll make. And that number, again, can be configured by accessing your My Social Security account, contacting us. We can reach out to you, and you can reach out to us, and we'll provide you with that specific number. So you need a minimum of, again, of 40 credits of coverage in order to simply qualify for retirement benefits. In the year 2023, one credit is equal to $1,640. And again, the max amount of credits per year is so retirement benefit filing strategies and options. The first is age 62. This is the earliest age one can elect to receive retirement benefits, regardless of when you retire from your employer. So if you retire from your employer at age, let's say 57 or 58, you cannot collect your Social Security benefit until age 62. And this does come with a permanent reduction of benefits. And so keep in mind, again, Social Security configures your amount based on the 35 highest earning years of coverage. So if you do elect to retire from your employer, and there are potentially some zeros in there for given years, again, we're looking at the average of the 35 highest earning years, not necessarily the 35 most recent years of coverage. So the best age to start receiving Social Security benefits really depends on your situation, right? It's not a one size fits all approach. As you can see here in this graph, if you take a permanent reduction at age 62, this is simply an example of how it would increase all the way up until age 70. Again, this example assumes the benefit of, so again, that does come with a permanent reduction if you're choosing to elect to take that benefit earlier in your lifetime, cost of living adjustments and things like that aside. However, again, your work history may result in you receiving higher benefits than this example here. but they're using a simple example here of $2,000 at age 67. So for someone who would receive $2,000 at age 67, if they chose to receive benefits at age 62, it would be $1,400. So again, there is a reduction that comes if you choose to take your retirement prior to your full retirement age. Now, your full retirement age does depend on the year you were born. So anyone born after 1960, the full retirement age is age 67, and the permanent reduction at age 62 is 30%. Anyone born prior to 1954, the full retirement age is age 66, and comes with a permanent reduction of at age 62 of 25%. And then there's some years in between during this transition phase, right? So anyone born in 1955, your full retirement age is 66 and 2 months. If anyone's born in 1956, it's 66 and 4 months. 1957 is 66 and 6 months. 1958 is 66 and 8 months, and 1959 is 66 and 10 months. Again, this is full retirement age. So this is to receive your full retirement benefit with no reduction in benefits. Again, you can elect to choose to receive your retirement benefit at age 62 if you'd like, but again, it does come with a reduction. You can take it anytime in between age 62 to age 67 if your full retirement age is age 67. So the best way to get that amount would simply be to create that My Social Security account. You can contact us, and we'll also mail out any statements that you'd like. We can mail those out to you as well if you're looking to receive that actual number. So again, full retirement age is 100% of your benefit, and there's no income limit at that age, meaning you can work as much as you like and choose to collect your Social Security benefit. You can choose to delay your retirement credit all the way up to age 70. There's an 8% benefit every year after your full retirement age, but age 70 is the last age that you can choose to delay that retirement benefit. So as I mentioned, you can work while receiving retirement benefits. If you are under full retirement age, you can make up to $21,240 a year, and there will be no reduction in your benefit. Anything after that, Social Security will deduct $1 for every $2. So again, if you're choosing to retire, pick up a small part-time job or something of that sort, you can collect your Social Security benefit. You can make up to that amount. If, for example, the amount that you earn and you're paying into FICA taxes, it could potentially lead to an increase in your benefit as well, and we readjust those based on what you paid in FICA taxes. So again, if you choose to collect your benefit under full retirement age, work that amount that you've worked and paid into Social Security while you're collecting benefit can also lead to an adjustment in how much you receive. And again, any month of full retirement age and above, there's no limit. $1,520 before the month of full retirement age. This example here, just keep in mind what that means is, for example, if your full retirement age is in July, you want to collect your Social Security benefit in January. So your full retirement age is July, you're choosing to elect your benefit early in January. You can actually collect your benefit and make up to that $56,520 before collecting that benefit there. So what income counts towards the annual earnings limit? We're looking for income that counts as earnings, so gross wages from employment and or net self-employment. Things like inheritance payments, income from investments, interest and dividends, capital gains, or any other resources does not count as earnings. There are some offsets for pensions, but that doesn't count necessarily as earnings, so we don't take pensions into account. Information regarding those type of government pension offsets and whatnot can be found on our website. Those are for folks who did not pay into Social Security for a given number of years. So again, if you've always paid into Social Security, your pensions will not affect how much you receive from Social Security benefits. However, if you worked for an employer who did not pay into Social Security, then it could potentially affect how much you receive in Social Security benefits. from the years that you did work and pay into the program. So Social Security does take additional family benefits into consideration. Once you file an application for retirement or disability benefits, we'll consider any other benefits that are payable to other family members, spouses, child, etc. Please keep in mind additional benefits do not reduce the payment of the retired worker. Again, additional benefits do not reduce the payment of the retired worker. We would receive that question quite often in the field. No, your former spouse or spouse will not be, stealing your Social Security, quote unquote. There are spouses and surviving spousal benefits available to individuals. Again, we're always looking to see which benefit is the higher of the two if your spouse is living. So you can potentially, if your spouse is living, you can potentially be eligible for up to 50% of your spouse's retirement benefit if your amount is less than 50% of theirs. So what that means is if you make and your Social Security benefit is higher than 50% of your spouse's, then you will not be eligible for spousal benefits. However, if you had a number of years where you didn't work and your benefit is less than 50% of your spouse's, you could potentially be eligible for spousal benefits if you or your spouse are currently living. Now, surviving spousal benefits are a bit different. Spousal benefits and ex-spouse's benefits while living, those rules apply at age 62. Again, you're simply going to file retirement. For a retirement claim, we look at your earnings, we look at your spouse's earnings, we look to see if yours is higher than 50% of that. And again, if it is, then you'll simply receive your own. You could receive a combination. Now, if your spouse is deceased and you're at age 60, you can choose to take that surviving spousal benefit and delay your own benefit. However, you can't do that with a living spouse benefit. We no longer offer that option. Accrue over time, and you can be potentially eligible for spousal benefits from their Social Security. So again, you can collect and later switch to your own retirement benefit. Keep in mind, again, we do all these configurations. We take all this into account when you file your applications. This is part of the application process. This is not something that you have to present to us. We'll present to you the various options that you'll have when we take your application, and it's part of the process. We evaluate to see if there's eligible benefits to you. So as Mike had mentioned in his presentation, we are not tax experts, so you can potentially pay federal taxes on your benefits, but it really depends on all the other income that you have in the household. So keep in mind that I would recommend you speaking with your tax preparer to see if you need to make a deduction from your Social Security retirement benefit. We can elect to deduct a certain percentage from your federal taxes if need be. So just keep that in mind. Again, we're not tax experts, and there's a variety of situations and where you can potentially pay federal taxes on your benefits. However, other income does come into play, and so obviously we can't speak on that specifically. So next, let's briefly cover Medicare benefits. There's 4 parts to Medicare: Medicare B, which is doctor coverage; Medicare Part C, which is Medigap or Medicare Advantage plans; and Medicare Part D, which is prescription drug coverage. So Medicare is our country's health insurance program for people that are age 65 or older, or people with certain disabilities. Now, if you're age 65, you're still working, you do not want to elect to take that Medicare Part B, you can choose to delay that if you're covered under a group health plan from your employer. And so simply when it's time to elect to take that benefit, you would fall under the special enrollment period. However, there is an initial enrollment period, again at age 65, which begins 3 months before or after your 65th birthday. However, again, if you're working and you have a group health plan from your employer or your spouse's employment, you can delay taking Medicare, and simply when that coverage stops, you would enroll into your special enrollment period. You'll have you and your employer fill out a form indicating that the reason why you did not choose to take Medicare at age 65 was because you were covered under that group health plan. Now, let's say you just didn't fall under these categories here. You simply just did not enroll in Medicare at age 65. There is a general enrollment period between January 1st to March 31st that you can enroll in Medicare. So this graph here shows the Medicare premiums for each income bracket. Again, most Medicare beneficiaries pay the standard Part B premium in 2023, which is $164.90. If you're not getting a check from Social Security, Medicare will bill you directly, but if you are receiving benefits, it'll simply be deducted from your monthly benefit. And as you can see here, the more you make, the more you'll have to pay in that standard premium. There are situations, for example, because we take into account your tax returns from 2 years prior, where you can appeal, that amount, basically stating that I had, a life-changing event. For example, that year that you're using for my Medicare Part B premium was a year where I sold a property, or it was an anomaly. Basically, it was a year that was extraordinary, so to speak. You can file an appeal, and we will evaluate whether or not it falls under that category. So please keep in mind that although you apply again for Medicare by contacting Social Security, information on our website, it is actually another federal agency known as Center for Medicare and Medicaid Services. They handle all the billing specifics and things like that. Again, Social Security will help you enroll in Medicare Parts A and B, and we send your application electronically to CMS, but CMS is their own federal agency. So there's 3 main ways to file for benefits, and you can file as early as 4 months of when you want your benefits to begin. The first is online. The second is by scheduling a phone appointment. And lastly, you can schedule an in-office appointment at your local field office. There are some limitations on child and survivor claims, and those can only be done by phone or in office. And lastly, before I head out, I also want you to mention to protect yourself from Social Security scams. Telephone and email scammers are pretending to be government employees. They'll try to scare you and trick you into giving them your personal information and money, so don't be fooled. Social Security won't threaten you. We won't tell you there's a problem with or suspend your Social Security number. We won't demand immediate payment from you. We won't require a payment by retail gift card, prepaid debit card, or anything like that. So just keep in mind, stay vigilant. You can report any type of scams at ssa.gov/scams, and you can report the scam on there. And we have our Office of Inspector General who investigates any scams that are occurring. You can give us a follow on social media. We embrace social media. YouTube has a variety of tutorials. Facebook and Twitter has some great information on given campaigns. For example, Slam the Scam Month. They provided information on various scams. Financial Literacy Month. They had all various how-tos and reviews of the Social Security statement and things like that. So give us a follow if you haven't yet. They have some great information that they post on a regular basis. So again, thank you all. I really appreciate the time, and congratulations on this next step in your lives. And I'll go ahead and pass it over.
Great. Thank you, Michael, so much. That's great information on Social Security. We appreciate you joining us. All right. So next up is Alice with the Employee Benefits Office. So Alice, take it away.
Hold on just a moment here. Let me get my video started. Good morning, and congratulations on your retirement. And Michael, thank you for giving us the information about Social Security. Just FYI, you have a couple of questions in the Q&A for you. And then let me get my screen up. All right, can everyone see my screen?
Yes, it is up. Thanks, Alice.
Great, move this out of the way. All right, so basically we're going to go over pre-retirement, things that you need to know as you're preparing for your retirement. And I'm Alice Kruger, the Employee Benefits Manager for the Employee Benefits team. So we're going to go over not what Mike went over, and actually I just want to put a plug in for Fidelity. Mike is part of the contract services that we have at the county. It's a perk that you have to meet with a financial advisor. So I definitely highly recommend meeting with him because he'll help you get information to make decisions about what you want to do next. But I'm going to talk a bit about a couple deferred comp programs and your final check from the county, and then the benefits that you can get in retirement from us. And I also want to say right here, thank you to Amy for monitoring the chat for me. So go ahead and put in any questions that you have in the Q&A. So our deferred compensation plan, that's your 457 or potentially your 401A if you're in a class that has that particular account. So when you're making your final paycheck contributions, you have the ability to put part of your part or all of your vacation accruals, your CTO, your HIL, those things can be put into deferred comp, and that helps you save on taxes. We'll show an example in a little bit of a pay stub and shows the difference between someone who has it paid out and someone who has it deferred. And you still will have Social Security and Medicare deducted unless you've reached the annual income maximum for the year already. So again, these are the accrual balances that you can use to defer into the 457 plan. Also, if you're eligible, certain job classes, half of your sick leave accrual can pay out. You can use that as well. There is a program that can increase the annual maximums that you're allowed to put in, the 50 plus program, and then the 3-year limited catch-up program. And these numbers go up each year. Right now, they are under age 50, 22,500 is the annual cap for the 457 contributions. Age 50 and over is 30,000. And if you enroll in the limited catch-up program, it's up to 45,000. These are the IRS maximums. So definitely check in with the Employee Benefits Office if this is something that you're wanting to do. There are different age and service year requirements for the 3-year limited catch-up, and there's an application that you have to fill out for that. And to give you an example, the IRS maximum for the limited catch-up is double the normal 457 limit. So in this case, the 22,500 times 2 equals that 45,000. You can only do special limited catch-up in the 3 years before your retirement year. It's likely a good idea to start that a little bit earlier in the year, because if you're starting later, you have fewer months in that year to be able to make contributions. So you may have to have increased contributions to make the amount that you're wanting to do. If this is something you're wanting to do, contact us. We'll make the underutilization calculation. So basically, in previous years, if you did not put in the maximum during that time, we can allow you to make that up to the IRS maximums. You fill out that enrollment form, and then it's processed, and the payroll system opens up, allowing for the increased contributions. And just so you know, those previous years can go all the way back to 1979. Hopefully, people who are working then are not here still and are enjoying their retirement, but you can go all the way back. Here's an example of a paycheck where someone cashed out the accruals versus putting the accruals to the 457 plan. As you can see, the federal and state taxes are over $1,800 when you're cashing them out, whereas if you defer it to the 457, those same taxes are less than $300. So it can benefit you from a tax standpoint. And then later, you can basically take that money out of the 457 when you're ready. Because your accrual payouts are considered supplemental income, the taxation on that final check is much higher than a regular paycheck. For example, it's showing right here someone who made $5,299.54 in their final check. Basically, it's going to times that amount times 26 paychecks in a year, and it's going to look like you made 137,000 plus in that year. And so you would probably be in a higher tax bracket depending on what you typically make. Okay, so we'll just pause for a second if we have any questions about the final paycheck contributions or the catch-up programs. And if not, then I'll go ahead and move on to the benefits section. Okay. Okay, so now we'll talk about the benefits that are available to you in retirement. You can still get medical, dental, and vision from the county. Separately from the county, you can also roll your life insurance over, and you elect that directly with the carrier. You also have an account if you're in specific unions, the Retiree Health Savings Program. And at that, as soon as you're retired and terminate, as soon as you're terminated from county employment, you can start using those county contributions. We'll go into that in more detail. And then the health savings account, there are eligibility requirements if you want to continue contributing towards the HSA. And then I highly recommend that you take a look at the retiree benefits summary. There's a lot of information there about each of these programs, and I'll give a link in just a little bit of where to find that. So just FYI, all your benefits end on the last day of the month that you're in active status. So, if you take a 2-week vacation just before you retire, it's that last date that you're considered an active employee. So even the vacation time would count if the county is still paying you your vacation. So if, for example, here they show on the calendar, if you're retiring on September 10th, your benefits would end September 30th. And basically any day of September that you retire, your benefits are going to end September 30th. And that's the active benefits. And then you basically can choose to move over to the retiree benefits if you like, or find benefits elsewhere. But just be mindful of the date that the active benefits are ending. So your choices, basically you can enroll in some of our plans, like you could choose to take dental and vision, but not the medical, or vice versa. You can take COBRA coverage, which is a continuation coverage. Anytime your benefits terminate, you're offered COBRA. You'll get that letter when you terminate from the county, and it will lay out all of your options. Or you can choose to go directly into retiree benefits. You can enroll in a different option, like your spouse or domestic partner's benefits. You can choose to purchase individual coverage. Maybe you're going to go out to the ACA insurance exchange. Any of these are perfectly good options. It kind of depends on your circumstance, what works best from you. But just so you know, if you elect coverage other than the county plans, there are a few limits on returning to the county program. You have to meet certain eligibility requirements. However, you can return if you meet those. So all eligible retirees can get the medical plans. Eligibility is based though on where you're living. Some of our plans are only the Sacramento region. And if you're leaving the Sacramento area before age 65, it potentially could limit what coverage options are available to you. Go over that in more detail. It is looking at your physical address, not your mailing address, just FYI. And I just want to make sure that you know that the cost for medical benefits is 100% retiree paid. And those deductions are taken post-tax from your pension check. The exception to that would be someone who benefits may be more than what their retirement check is, then we're going to be setting up more of a self-pay type of arrangement. And I just want to make sure to note here that if you choose to take the COBRA continuing coverage, that is your coverage, and you can't have COBRA and the retiree benefits at the same time. It's one or the other. Okay. So we have a couple different sets of plans. So the first ones are non-Medicare. So if you're under the age of 65, we have the same options that basically that you had as an active employee. There's Kaiser, there's Sutter Health Plus, Western Health Advantage. You can choose to use an HMO or a high deductible health plan. And just so you know, if you went directly from an active plan to, from an active high deductible health plan to a retiree high deductible health plan, your deductible will carry over. So you're not starting fresh with a new deductible that year. Then we have our Medicare options, the Medicare Advantage plans for people that are over age 65 or disabled. If you have, just to make sure you know, if you already have Medicare Parts A and B, when you retire, you need to make sure that you immediately enroll in the Medicare Advantage plan through the county. That's if you're wanting to keep our coverage. So we have a couple different options for Medicare Advantage plans. We have the Kaiser plan. We have both a gold and silver options, so two different benefit levels. And then we have through United Healthcare, either an HMO or a national PPO. And I just want to point out here that when you're enrolled in Medicare, even if you're not in county-sponsored options, there are some benefits available throughout the country if you decide to relocate through basic Medicare. Another thing to make sure to know is if you're on a Medicare Advantage plan, you do not need to enroll in a Part D prescription plan. It's already included in your plan. And if you do enroll in it, it's actually going to drop your coverage with the county. So please be very careful about that. And then I want to talk about, out of area coverage. So again, some of our plans are only covering in the Sacramento region. So if you're traveling, only emergency coverage is going to be available to you, not going to your regular doctor for regular care, but something like an emergency room visit or things in those vicinities. If you're moving, it's a good idea to contact the employee benefits office. We'll help you go through the options and what's best for your specific circumstances and what plans are available. Potentially, it might be good, depending on the area you're in, to go with one of our plans, or it might be better to look at the Affordable Care Act plans, depending on where you're going. So, for example, the county does have Kaiser coverage in some specific states, but not all, just areas that Kaiser serves. And then, and there's different rates depending on what state that you're in. Additionally, we do have a nationwide PPO through Western Health Advantage, who partners with Anthem, and then also through United Healthcare if you're a Medicare retiree. So the Western Health Advantage Anthem is just for early retirees pre-65, and the UHC one is for the Medicare Advantage or disabled 65 plus. Okay, so moving on from the medical plans, we also have dental available to you, but I want to make sure that you know that the plan design, the benefits are different in the retiree plan than in the active plan. But we do offer two different levels. You can choose a standard plan or an enhanced that has a higher annual maximum. I also want to point out that using the preferred providers through Delta gets you a lot stronger benefit. So, maybe look at what dentist you're using, and I know that it does decrease your costs if you're going to a preferred provider with Delta. Also, I just want to point out again, dental can be chosen through COBRA continuing coverage. And again, you can only have one or the other. You can do the COBRA or you can do the retiree benefits for the dental. So make sure you know that. We also have a vision plan for retirees. That's through VSP. And really, the plan design is exactly the same for the vision. So the main things are that you have a $15 copay for your annual exam. And I know that some medical insurance also cover your eye exam depending on the provider. Also, through VSP, the frame allowance is $130 every other year. And then again, just the same thing. If you elect COBRA, continuing coverage for vision, that's your coverage. You can't do COBRA and the retiree vision plan. So one or the other. Okay, so life insurance and the critical illness plans. So these are not, these actually aren't through the county. Once you separate, it's actually, you transfer the coverage over to individual coverage instead of group coverage. It is more expensive, but you totally can convert your group coverage to an individual whole life. So what you do is when your coverage ends, if that's what, there's a packet that you fill out with Voya to transfer it over. Just so you know, there's no cash value to the county coverage that ends. And for questions about the conversion, you'll want to contact Voya. All of that information is included in the COBRA letter that you receive from the Employee Benefits Office. So, or you're welcome to call us to get that information as well. Okay. So I just want to make this note down here at the bottom in red. So if you're under age 60 and you become disabled while you're an active employee, there is a premium waiver that's available, but we would need to make sure that we have that process prior to your separation. So if you're in that situation, please let us know and we'll help you out. Okay, so the retiree health savings plan. Some unions don't have this, but most of the county bargaining units do. Basically, it's a $25 employer contribution account. They $25 per pay period that the county put in for you. And you can start using that as soon as you terminate from the county. So the same day you retire. So make sure you're saving receipts. It sometimes takes a week or two for the system, the claim system to realize that you're terminated from the counties, just so you know. But you can turn them in as soon as you're retired and that your claim is turned on, you can start submitting those claims. Basically, it's tax-free reimbursement for your health expenses. You can use it for you, your spouse, or specific dependents. And the claims administrator through Mission Square is Meritain. Just so if you see that name, you know it's the same. And they'll mail you a benefits packet for you to fill out. And they actually have online claims processing. So you can actually upload your receipts and put your claim in right online as well. There is a quarterly fee to the retiree health savings plan. So I do recommend, use this right away. When you first start retiring, you have any health expenses, start submitting those claims and spending this down. Okay, so reimbursements, the type of things that you can reimburse from the RHSP are like medical, dental, and vision expenses. So your co-pays, out-of-network costs, your lenses and frames, anything that you're spending on those kind of things. It also can cover prescriptions and Medicare Part B expenses. You can, if you have something that's ongoing, like your premiums, you can set up a recurring monthly reimbursement through them. So then you don't have to, you put it in once and don't have to worry about it. They can set up direct deposit where it goes directly into your account. And you can do all of that on the website, or you can do it through the packet that Mission Square sends out to you. Okay, so the health savings account, if you have been in a high deductible health plan, you may have been putting monies into your health savings account. And these do follow you into retirement. You can continue to spend those monies on eligible expenses. You cannot do HSA contributions through pension payroll. So if you're wanting to continue contributing to the HSA, there are eligibility requirements, and you'll need to set that up with the agency that you have your HSA with. They can, so basically the requirements are you have to still be enrolled in a high deductible health plan to be able to put into it. You can't be on a Medicare plan. And then also you have to have already spent down your retiree health savings plan if you're wanting to contribute to the health savings account. So that's why it's important to do the RHSP first. It's the least flexible. It only has certain things and certain dependents. It doesn't transfer as easily the same way that an HSA does to your beneficiaries. Also, another perk of the HSAs are you can basically take them out for non-medical expenses. If you're under 65, though, there is a 20% penalty. If you're over 65, it just makes that money taxable. So I think that's the big draw of people putting into HSAs is they're tax-free going in, it's tax-free on the amount that the interest that you accrue, and it's tax-free taking it out. So there's rarely a vehicle, investment vehicle that has tax-free 3 times like that. But as long as you're using it for eligible expenses like medical, dental, vision, hearing, etc. So, but it is nice that it has the flexibility. If something happens, you can use those monies without penalty if you're over age 65. Also, if you're over age 65, you can start using those monies in the HSA for medical premiums for yourself and your dependents. So that's another plus of the HSAs. All right, so let's just say that you decide, nah, I don't need the benefits from the county. I'm going to go elsewhere for my benefits. You can return to the county after you've waived, but there has to be during specific timeframes. So number one, you have a life event, you lose your coverage that you have elsewhere, you become Medicare eligible. Now you're going to sign up for a Medicare Advantage plan. Sometimes with adding a dependent coming off, those are all life event type of things. Get married, get divorced, those kind of things. But I just want to point out that if you're through Covered California and you lose those benefits, that's not considered an eligible event. Also, let's just say you were on COBRA and you stopped paying your premiums. No, that's not an eligible event. It has to be lost for other reasons. Like, let's just say you were on a spouse's plan and they quit that job or left that employment, and now you're no longer on that plan. That would be a life event. Also, every year during open enrollment, you can join, and we do that in October every year. In fact, this year, the dates are between October 2nd and October 27th. We will be having 4 active open enrollment events in person and 2 retiree events in person. There will also be online information for you through our AirBo site for open enrollment. So all the information you need is there. But I want to point out that if you've waived initial enrollment and you're trying to come back onto the county plan during open enrollment, you have to provide 12 months of continuous credible coverage, meaning that the coverage met the requirements of the ACA. And if you can show that proof of 12 months, then we can accept you back. And then there's more details about all of that. It's in the retiree My Benefits Summary. We also have a policy for retiree insurance. And so you can go look at those things on our website. I'll show you that in just a minute where that is. So let's just say you need to change your coverage. So you can change to any of our plans that you're eligible for during open enrollment. Again, that's in October and it becomes effective January 1st of the following year. Let's just say you move in or out of the service area. That's potentially a qualifying event. You have a new family member, you're dropping a family member, you lost that plan. Like I said, the other plan that you had through your spouse or domestic partner. Just so you know, in those life event cases, it's effective the first day of the month after the event and the enrollment information given to us. So if any of these things are happening, please contact us. We can help you see if that necessitates a change, like you're moving in and out of the service area, that kind of thing. We can help you. And then also, I just want to say, you know, we send out materials each year for the open enrollment. Please make sure that you review them because there can be premium increases or changes each year. The coverage or plan design may change some. So we'll make sure to point out any changes from the prior year in the materials that we have. So make sure and review those each year. And then we have retiree benefit information online. It's easy to access. We have forms and documents and resources, links to the vendors and providers that we have. There's a lot of information on these resource pages. So here's the link. And you can get this, you can access this while you're at home or at work. It doesn't matter where you are. It's not an inside personnel services, that it can be accessed outside. And there's a sample of what the My Benefits summary looks like. And then our contact information, we are at 700 H Street downtown on the 4th floor. There's our phone number, and there's an email for retiree benefits there. And then again, a link to a pre-retiree resources. So you can look over the information there. I encourage you, if you have questions about the benefits or the transition between active and retiree, or even transition from, you know, regular benefits to Medicare Advantage plans, please reach out. We'll assist you. Okay, any questions about retiree benefits? All right, thanks, Amy, for keeping up with the chat for us. And I just want to say congratulations to everyone on your retirement, and thank you for your time today. I wish you well.
All right, thank you, Amy. I appreciate you, Amy. I said Amy because you just said Amy. Alice,
Yeah.
Alice and Amy, thank you for your participation. Okay, and to wrap us up, close us out is Randy with the Sacramento County Retired Employees Association, or SCREA. So I'll let Randy join, and then I'll come back on and close us out.
Good morning. Thanks for taking part. It says I cannot share my screen while the
Hold
other
on,
participating.
let me stop my share. There, try that.
All right. Let's see if I can do this. I'll do this again. All right, let's see. Can we share the screen? There we go. Can you see this? All right. I'm from
We see
SCREA.
you, Randy. Are you sharing a presentation?
Yes, I am.
Okay, I think it might be, you might need to drag it over to your screen, so we're seeing you.
Is it not on the screen now?
It is not.
All right, let's try this. Is
Okay,
that
now
on
it
your
looks
screen?
like, there you go. Now it's up.
Okay. Well, as you can see, it takes quite a bit of consideration just to retire. And what we do is, when you finally make your decision to retire, like my dad told me when I was a little bit younger, you don't retire from something, you retire to something. So make sure you have something to do when you finally decide you're going to pull the plug and start a new life. And that's exactly what you do. You're starting a new life. SCREA is Sacramento County Retired Employee Association. We are the individuals or the group that represent you after you retire. We were established in July of 1975, incorporated in 76. We have almost 5,000 members, and we're the only recognized organization that represents all the retirees. And our members are open to all retirees and their spouses. Our purpose is to promote the welfare of retired employees of Sacramento County. And we want to represent them properly and with a little bit of benefit. So we're a business organization, we're a social organization, and we also try to make sure that we stay on top of regulations, legislation, and attacks on public pensions. And that's what we try to keep up our activities in the process. We're a 17-member board. And you kind of ask yourself, why do you need 17 members? Well, you got to remember, we're retired. Many of us get lost. So we travel, we do things. So in order to have a board that it's large enough to make a difference, we have 17 members. We meet with benefits. We try to meet with benefits, county benefits, as often as we can. Try to get there once a month or at least somewhere in that area. We negotiate with the Board of Retirement, the Board of Supervisors, County Exec. Our members are in a statewide organization for county retirees. Sacramento County is a 1937 Act county. There are 20 1937 Act counties in the state of California, and we are our member of that organization. It's called California Retired County Employee Association. We publish a news brief. We try to do it quarterly and to give you guys information about what happens and when. We also have a website, as you can see on the bottom of this. I know we've been at this for a couple hours now, so I know you're probably getting tired of it, but let's consider a little bit more. We're a social organization. We have 2 lunch meetings a year. We try to have 2 lunch meetings, March and June. March, sometimes we don't get a chance to. We have a picnic in September. We have a holiday luncheon in December. Our luncheons are subsidized for all members and their affiliates. And the board of directors elections are in June. So we just had a board of directors election. What have we accomplished? We advocate at the Board of Retirement for inclusion of alternate retiree members on board. We advocate for the Board of Supervisors, and we also fought for the retention of health insurance subsidy up to including we filed a lawsuit against the county. Obviously, we lost. We provide members access to supplemental benefits. We have AFLAC, which is an insurance program, Pacific Group Agencies, which provides numerous different benefits at a discounted rate through the association. We have representation and advocacy and political process. Try to keep our nose in to what's going on in the politics. Some of the politics are against public pensions. They're trying to destroy public pensions. We're trying to keep our nose in on that. We become an information source for the retirees. We like your input because that's where we get a good number of information. We are trying to ensure that there's a benefit retention and protection of the retirement benefits. We try to maintain contact with our colleagues. That's a big issue, to try to figure out what happened to those people we used to work with. 30, 35 years we work with some people, and then all of a sudden we retire and lose them. This gives us an opportunity to do that. And then we have dues. Our regular dues is $2 a month, and affiliate dues, which would be spouse or a significant other, would be $1 a month. These went up. What we're asking is to be sure to fill out your packet when all of this stuff takes place, when you do decide to retire, and become a member of Sacramento County Retired Employees Association. Your membership entitles you to numerous advantages and discounts, and we hope to see you there when you finally retire. Remember, retire to, not from. Thank you.
All right, thank you, Randy. Let me bring up just this last slide here. I just want to thank everybody for joining us today. I know it's a lot of information. I hope that you found the information helpful as you plan for retirement. And we want to thank our partners from the Employee Benefits Office, from Social Security, from Fidelity, SCREA, and all the panelists who've been behind the scenes answering your questions throughout the presentation as you posted them. We all know that retirement is exciting, but it's also scary too. So we're all here to help you make a smooth transition into retirement and feel comfortable with the decisions that you're making. So please use those resources. That's what we're here for. Staff is going to remain in the Q&A for a few more minutes. I see some things being posted, so we'll keep that open for another 5 to 10 minutes so that you can keep asking those last minute questions and get those answered. If for some reason we don't get to that question, please reach out to us at the contact information. We have both SCERS and the Employee Benefits information here, but I know that Mike also shared his contact information. Michael shared the resources for Social Security, and Randy had some contact information up there as well for SCREA. Also, once you leave the webinar, you'll receive survey request. So we would really appreciate if you take a few minutes to provide your feedback. That helps us make improvements and know if there's any tweaks that we need to make to future sessions. So again, thank you so much for joining us and enjoy the rest of your day. I'm going to stop the recording, but again, we'll stay online here for another 5 to 10 minutes to keep answering those questions for you. So thank you. All right, it looks like the questions are virtually gone. So if you are still on the session and have a last minute question, we'll keep it open here for just another minute or so. And then I will end the presentation. So get that posted quickly if you have a question. Otherwise, just reach out to each agency at the contact information provided, and we'll be happy to answer that question separately. Okay, it looks like our Q&A is cleared out. So again, if you're still on the line, I'm going to end the presentation. And if you have any follow-up question, please reach out to any of us based on the contact information that we shared, and we'll be happy to answer. Thanks so much for joining and have a great day.